By definition, hedging is making an investment to reduce the risk of adverse price movements in an asset. Normally, a hedge consists of taking an offsetting position in a related futures contract. In a true hedge, the moving piece is considered basis. I think you guys know what basis is, but basis is the difference between cash, flat price, and the futures market. Few things to remember. Basis direction is referred to as stronger or weaker. Now, I can't say that this is my line, but I enjoyed it when I heard it. Somebody was talking about grain merchandisers being C plus, some C minus students. So when we start talking about negative basis or under basis, and the change in a basis negative number getting stronger or weaker, then you're starting to cross out negatives and turn one into a positive, and it just gets confusing. So stronger or weaker is the best way to terminology to use, instead of trying to say higher or lower. A higher negative or a lower negative, again, can be a little bit confusing. And basis reference is made to underlying futures month. For example, the March or the May, and all that's saying is, as you're looking at a basis value, it's very important to know what month that corresponds with. 10 under the March in a carry market is a lot different than 10 under the May. So just know what month you guys are quoting off of, especially as you roll, as you get out of futures positions and start to bid off the next
right
month.
now is a perfect example. We're bidding off of the May, but yet everybody's screen will have March on the very top,
Right.
and a lot of you, for some of the new people, you know that we're not basing it off of the very top line anymore. We're going to the May contract on corn. So
Especially,
it's tricky.
yeah, in origination
Very
terms,
tricky.
especially if a farmer calls in and just asks basis. What's your
Sure.
basis? And you say 10 under. He's probably getting a quote for March on his text, or is looking at the screen. He's still looking at March. So make sure as you quote basis to say we're 10 under the May, we're 10 under the July.
Scott, you might even put something on. Whoever's doing the hedging, we might even put a K or something on there. It is. I gotta think. The cash bids showing that it does so on the
I
basis.
try to highlight the first when we roll it. I try to
Okay.
highlight the first day, highlighting that we're
I
changing.
don't remember seeing it on there.
You
Okay.
gotta look a little closer.
But
Okay.
then that gets deceiving too, because we're 11 under now against the May,
Yeah.
which looks weaker than what we was at 6 and 7 under the March, but it's actually about a stronger number with the spreads being considered as far as a
But
cash.
yeah, the bid sheet has the K or the H or the N. The bid sheet all has that, and as we memorize those, then that's another point. I try to highlight the first time we use a new futures month as well.
Okay.
So, but yeah, it gets tricky. That's for sure.
Yeah, we could do some fun exercises on that.
Yeah.
On that nearby month, once it's gone into delivery, then it can be unlimited if we have
Right.
volatility.
That's correct.
to be-
Excellent point.
That's a good point, right?
Yep. And something that a lot of times we forget to put in these presentations, and I think a lot of new traders forget that as well. When you're in delivery, there's no price limit. You know, every other month is capped on the limit move for a day, but you can especially get in some hairy situations.
Yeah.
Bidding off the wrong month and it's in deliveries.
What do you think we buy off of that, Scott, on an annual basis? How many boo-boos do you think we have? Catch a day, we're nearby month, and we're not like now. You could have March beans up 20 some odd cents. We're going off May, and they'd be up 11. Well, we've overbid by 10 cents. Next thing we made zero margin.
Yeah, it's tricky. It's like I said, we try to highlight on the bid sheet when we send it out, and like I said, these are good exercises as well. But I've made the same mistake, believe me, when I first started, and it's not hard to do when the futures month is still on the screen. It's not hard to do. So it it's about memorization and
And everybody does make that
yeah,
mistake, I will say
yeah,
that.
absolutely.
Just we'll do some exercises in the origination part.
Yep.
One of the things we talk about is just take your time.
Yep.
Yeah, the market's moving, but don't let the farmer pressure you for, what, I need a quote now, blah, blah, blah. Risk on you guys, take your time, know what you're quoting. Don't need to spend too much time on that slide, but just who hedges. It's buyers of grain, it's sellers of grain, it's farmers, livestock producers, elevators who are carrying inventory, food processors, feed manufacturers who need a raw material to make a final product, industrial users, importers, anybody who has risk of prices going higher and lower ultimately. And it's important to know what your risk is, I guess, was that last line. That's a key part of that. What side of the hedge you're going to be on. Is your risk higher prices or lower prices?
What's an iceberg order?
Yeah, sorry, I didn't mean to.
Silent placement.
So these are types of orders with some people still call in orders, but as technologies change, a lot of people are putting in their own orders. You guys may be a mix of the two, but again, it's important when you're talking to a farmer too to know what he wants and what this specific type of order ties to. Farmer calls in and says, "What's your cash bid? Okay, what number are we looking at? What month are we bidding off of?" If he says, "I want that," lock it in. What's your guys' choice on the backside? Well, you've bought the grain. You contracted that. Do we want to put in a limit order? What the market do while we were on the phone? Do we want to try to get higher or lower than what we quoted, or do we execute at the market? There's probably policy within here on that. But a market order is fill right away. Limit order is what I consider for targets. You know, farmer targets are going to be at a limit, usually higher than where the current price is. A lot of those are good till cancel or good through date. So as in the past, when there was a lot more calling into our office to execute orders, you know, this was the terminology that we tried to have people use. Market, limit, good till cancel is ultimately until that expires or you tell me to cancel it. Good through date is I want to try to get X price by the end of July because the volatility's, you know, planting or weather. Stop orders, won't talk too much on those, but they can get a little confusing because you're trying to limit your loss on a position. So stop loss, stop sell is going to be actually below the market currently. Icebergs, for your question. When did icebergs get really come into the market, Jeff?
They're just a function of the electronic trade.
Okay, but I feel like maybe we focused more in our office the last 2 years on them. But what an iceberg order is it's blocks of an order that you're going to show the market. So if you guys were trying to trade a 200 lot spread and you put that all in at once, that's going to show up in the bid-ask volume. So somebody knows, okay, we're getting really heavily weighted on this side on somebody trying to buy the front month. An iceberg order allows you to show certain parts of that order at a time, and then if filled, it shows another 20.
So it's just a counter to get picked off by an HFT.
Yes. Which a neat chart came out over the weekend on somebody that was supposedly manipulating.
The stop order is an order that I can put in for any of our customers. Say today's price is $3.80, but let's say you have a customer that's going away or leaving on vacation. They want to be sold if the market it's $3.80 today, and if it gets to $3.70, they want to cash out. That's an order that we can take and we can put in for someone. So what it's saying is, as long as the market stays above 370, I'm fine with just leaving it where it is. You know, I'm going away or whatnot, and that's fine. If it gets down to 370, I want to stop the bleeding, so to speak, and I want to sell my grain. So that's an order that I can put in. I don't have to be up in the middle of the night if it gets there. It's something that we can put in. But that's another way to use a stop order in the cash market, is to stop the bleeding on the market going down.
And it's
Just
a
as
good
an
one to
idea.
use in a rallying market if a guy doesn't want to sell because he's afraid it's going to go up.
But it's definitely something that we can offer if you're talking to someone, and you know, there's no fee to it. It's not hard to manage on our end. Every night we have a basis, and
you can take that in and out.
yeah, you can take it in and out. Yep. Stop orders. So
One that I have for customers that I gave a name is cancel if it gets close.
Oh yeah. Call me if it's close,
Close,
cancel
yeah.
if it's close.
They'll put an order in, and then as soon as it gets close, then they call and they want to cancel it. So
Right. Or it touched
Don't
it
take
and it hit it, and then no, I don't want to order in, and then it drops off, and well, I thought I had a target in there, and
That's called a CIC order.
Yeah.
There's also a GMO order. You ever heard of those? It's when you did something wrong, it says, get me out.
Yeah.
So anyway, but that's-
Great comments on the stop. I guess I wasn't thinking of them as much of a use from the cash grain side. I usually think of them as people that are speculating that have a position on and trying to limit bleeding. But it is a good, I didn't use them much on the cash side, but it's a good avenue, yeah, if a farmer says, hey.
It is 2/3 of our market, the farmer, which is a speculator, right? Or more.
Ultimately, yeah, right.
The other thing that happens sometimes is when they've got an offer in and just got heavy trading and, it just ticks up there and they think it should have been filled.
Right. And I don't touch on that, but that's a great point to bring up is when you're talking to a farmer on a limit or an offer, sometimes it's good to talk about the basics behind the market, that you're not guaranteed to fill unless it trades through that price. And it's a complex algorithm of whose orders get filled first and how long they've been in there and volume of that the order is. But at the end of the day, that's not your guys' fault or ours as far as the executor of that trade. It's just, there's if there's 100,000 orders sitting out there to sell grain at $4 and there's only 60,000 people willing to buy grain at $4 and those hit, not all that volume is going to get filled. So when a farmer has a target and says, oh, I saw the high today, it was $4. We got that 100,000 bushel filled. No, we didn't. What? So one of the things you can do in that situation is pull or call brokers and pull time and sales, and really you can actually pinpoint the volumes that are traded at specific times, which may not make him feel any better, but your guys' risk on your end is as you're putting in a limit order, what's your policy on guaranteeing that fill? When are they filled? If it trades through it or if it touches it. So good conversation and good point. Last little thing on types of contracts. We went through markets. EFP is exchange for physical. Likely most you guys won't use these too often, but as a merchandiser, this is how you price most of your sales contracts. And really all it is an agreement with the person you're selling the grain to, the processor, the river. And the reason behind it is it eliminates slippage. So instead of calling the processor, Keokuk, and saying, hey, I got a 50,000 bushel basis contract, let's price that out, or I'm selling you 50,000 bushels, let's price it. Okay, you buy your grain back, I'll sell mine, and we'll exchange, or we'll price out the contract. There may be slippage there where somebody gained or lost. And as we go forward, we'll realize the futures component is not what we worry about, it's just the basis. So to avoid that, let's just agree upon a price, and we'll price the contracts at that, and we'll exchange futures to offset our current position.
One thing on that, have you guys run into any requests from producers to do EFPs?
A few.
One or two.
Some.
A few.
Very, very, very little.
Okay,
I would guess that's going to increase.
Yeah.
good point. As more of them are using tools.
If any producer says something about that, call myself or Tim, and we'll walk you through. In general, we don't do very many.
We don't have very many guys that are to that point. And one of them's actually a gal, so I shouldn't say
Yeah,
guys.
that's right.
Producers.
Yeah, and maybe it is growing. I know that we've had a few guys in our office talk about it from the farmer marketing side. Actually, now that you bring it up, Jeff. So
The more that works with some AT or other traders that are on there, they basically got their own futures position,
Sure.
and they're to exchange it for a sale. So
Yep, right. Instead of them having to buy back out of that position or offset it in their account and have you guys execute it, maybe it eventually will go to an exchange. One thing to remember about them is they are not time sensitive. I say that loosely. I mean, you don't want to have the pricing established at X value and then not put the exchange in for 3 or 4 days, because there's probably some CFTC rules on that. But as far as actual execution of an EFP, they can actually be done after markets are closed. It's just an agreement for two parties. And if they are executed, and I'm still amazed to this day that this happens, because you would think, all right, Scott talked to the buyer and he said the price. Somewhere between that and the two parties meeting up and actually exchanging that, well, no, I was supposed to buy, you were supposed to sell. Exchanges get cleared at the wrong prices, wrong volumes all the time. And those are pretty easily to bust out of, just a little backing. But terminology, when exchanging, the give is the sell side, the take is the buy side. So if offsetting a short position, short hedge, you would take futures. The easiest way I always remembered that is if I'm selling grain, I'm giving the physical and I'm taking futures. And the opposite if you're buying. And probably not something you guys are using every day, but just good to know. Alrighty. Good on pace here on time. Alrighty. Going to continue to kind of build some of the terminology. We're going to revisit some of this stuff in the origination part this afternoon, and I'm not sure how many option contracts you guys use, but for some of you guys maybe it is the first time seeing options or hearing about options. So a little terminology with options. Premium of an option is the cost associated with the strike. Exercise is converting the option to an underlying futures contract. So just like futures, options eventually expire. If they expire in or out of the money, depending on what level they're at, they eventually become a futures contract. Strike price is the underlying futures price of option. I got a chart coming up, but that's probably an important one to think about when you're talking to a farmer. What strike do you want to trade? So if December futures today are at $4, and somebody says, "What's a 420 call worth?" That 420 is the strike that you're looking at, and that means I want to know what the option on a $4.20 futures contract would be today. The Greeks, won't talk too much about them. We talk a little bit about OTCs later on in the day, but that's where the technical and the algorithms and everything else kind of come into account. So we were talking about strikes. This is a quote screen. I don't know how many of you guys look at options on a daily basis, but they're traded in various strikes. The strike, like I said, corresponds with the futures position. So for a March 420 call, that would give the opportunity for the buyer to be long at $4.20. We'll talk a little bit more about the background on those a little bit later. I'm not going to get into that much right now, but if owning a 420 call and futures are at 380, the market is below the value of that call. So when the market's below a call, that's going to expire worthless. Various strikes you can see over there down the middle, puts and calls on both sides of them, trading eighth of a cent increments. Probably the biggest thing for you guys to remember is just that strike. If a farmer does want to use an option, know where to look, know whether it's a call or a put, and that's the premium for that option. Probably should have had that slide before, but call options, agreements that give you the right but not the obligation to buy underlying futures. Put options, agreements that give you the right but not the obligation to sell underlying futures. So if you think about that in terms of what has value, if you see a call option that's trading $4.20 and the market's at $4, if you buy that call and the market is lower, somebody doesn't really need the right to buy grain at that higher price. So it's not going to have any value, right? Nobody would want to buy $4.20 corn if the market was at $3.80. vice versa with the put.